Let's get back to our top line story. U.S. tax reform fueling optimism in the markets. We're going to get some perspective now on the positive reaction that the tax plan is having. Bringing our feature guest, Diana Avigdor, head of trading at Barometer Capital Management. Always good to see you, Diana.
Thank you very much for inviting me.
Okay, so this is what we had been waiting for. The Senate pushed a bill through and definitely seeing money moving in very specific directions, including financials. All of this making sense from your point of view?
It does. Actually, though, tax reform does not come in a vacuum. There's lots of other good things that have propelled markets to new highs. Even without the tax reform, we were already skirting new highs, and we've just breaking out again. The rotation has certainly started last week, selling of the technology stocks in favor of those that are perceived as more benefiting from the tax reform. However, technology stocks are not disadvantaged by the tax reform, but they benefit less, maybe relative to some other sectors. Benefiting less does not make them losers, but in an economy and in a market and in an investment outlook that is fully invested, maybe some money is moving from a really well-performed sector to lesser so. However, it's also the highest growth sector, has had the best revenue sector, as we've seen in the last earnings report. So I don't think there's anything sinister about it. I think it's okay. Financials have been held back somewhat by the flattening yield curve, as well as the tax reform maybe not going through or not. So they're getting some of the well-deserved money.
I find it curious, and it makes a lot of sense. You say, okay, I want to be in financials given what happened over the weekend with the Senate passing their legislation, and I need to get the money from somewhere, and I've made a lot of money in Facebook, Amazon, Netflix, Google. But I've been hearing a lot from money managers this year that they have a lot of cash on the sidelines too, and that this market's just a lot of people are waiting to deploy that cash. Do you think people are still holding on to cash? That speaks to me as caution. If I'm selling what was working to buy something that I want, but I'm leaving the cash alone, maybe I'm not 100% sure of
100%. And Catherine and I have been talking about this in the past. Actually, the last interview, we were talking about the leverage of the hedge funds in the market, and that it has been so high, and then maybe it's over exuberance. There is no exuberance in this market, and analysts and strategists have just actually, I've only seen one put in any kind of tax reform number into their numbers. And companies in their guidance have not actually guided for any kind of tax reform at all. So if the tax reform does go through and some of these companies really perform well or have a boost because of lower taxes, that wasn't in their guidance. A lot of managers try to catch tops. As we know, we don't know tops until that's a hindsight 2020 type of situation. We don't know when the top is until we've seen it happen. For now, for our discipline, we go through a lot of particular metrics, and then we have been bullish and we have been fully invested, and we're still fully invested. And our top three sectors are technology, financial, industrials, has been for a while, and despite the rotation, that still stays that way.
Diana, I like how you said if the tax plan goes through, because of course people say, well, didn't the Senate pass it? But Senate passed its bill, the House passed its bill. Now we got to find some common ground, put them together. The president wants something on his desk before the Christmas holidays. If indeed that happens and the president gets to sign off on something, we actually do have a tax cut plan, do we see another huge jump up in the markets on that?
So it's an interesting concept, and we have to kind of think through it, what's priced into the market. I think that the market is positive for more than just the tax reform. So let's assume it goes through. Is the market going to make a jump just because of the tax reform? It's not going to be just because of the tax reform. There is global growth happening, and earnings growth, and even sales growth we've seen, and there is a tax reform. And we have a President Trump that has signed 50 different regulatory objectives, of which 7 were just regulatory that affect the financials. So there's lots of reasons here that the market can go up. In terms of just taxation, the headline tax in the U.S., corporate tax is 35, but their effective rate is probably around 26, 27%.
Yes, how much bang do we get for our buck going from an effective rate of 26, 27 down to 20?
To 20, so that's a little less than the headline, of which, you know, some of the repatriation, for example, that's also in this conversation, cash held outside would be at around 10%. And you know, the market thinks it'll be brought in because it's temporary. Where will that money go? Will it go into new employees and wage growth and so forth, or will it be to buy back stock? Probably buy back stock. So how much more is in the market? Probably 3 to 5%. But there is an uncalculated benefit from a regulatory, from a business environment perspective that is more robust and more attractive to corporations. There's a lot that can happen that is not just in calculating the cold numbers. There's a leverage effect of CEOs and heads of departments that will invest in the business differently, hire people differently, invest in plant and equipment differently when there is a friendlier environment.
I want to ask you quickly before we get a break. You mentioned the flattening of the yield curve. Now, of course, if it ends up inverting, we're going to start hearing the R word, recession. How concerned do I need to be about that? Do we all need to be about that?
The world has talked about this flattening yield curve for a long time. We still haven't heard from the Fed how they're going to normalize the balance sheet. That's still out there, and so of course the yield curve is flattening as rates in the short end are moving up and the long end is not moving. If it inverts, and if it inverts, it could go to 30, 40 beeps difference, and it's now around 70. So there's a long way to go to invert, and if it does, it takes about a year or two before there is an impact on the stock market. We are having a recovery here, and rates are going up for all the good reasons. It has been shown that rates need to go up to about 5% before it starts impacting equities negatively. We're far from there.
Okay, we're going to be back with our featured guest. She's going to tell us where she's putting her money to work after the break.